The Natural Rate of Interest is Zero by Mathew Forstater and Warren Mosler. The natural rate of interest is zero. If spending is not revenue constrained, why does the government, conceived here as a consolidated treasury and central bank, borrow, sell securities? As spending logically precedes tax collection, the government must likewise spend sufficiently before it can borrow. Thus, government spending must also, as a point of logic, precede security sales. To cite a real-world example, market participants recognize that when Treasury securities are paid for, increasing Treasury balances at the Fed does repos on the same day. The Fed must add so the Treasury can get paid. Since the currency issuer does not need to borrow its own money to spend, security sales, like taxes, must have some other purpose. That purpose in a typical state money system is to manage aggregate bank reserves and control short-term interest rates, overnight interbank lending rate, or Fed funds rate in the United States. In the contemporary economy, government money includes currency and central bank accounts known as member bank reserves. Government spending and lending adds reserves to the banking system. Government taxing and security sales drain, subtract reserves from the banking system. When the government realizes a budget deficit, there is a net reserve add to the banking system. That is, government deficit spending results in net credits to member bank reserve accounts. If these net credits lead to excess reserve positions, overnight interest rates will be bid down by the member banks with excess reserves to the interest rate paid on reserves by the central bank, 0% in the case of the USA and Japan, for example. If the central bank has a positive target for the overnight lending rate, either the central bank must pay interest on reserves or otherwise provide an interest-bearing alternative to non-interest-bearing reserve accounts. This is typically done by offering securities for sale in the open market to drain the excess reserves. Central bank officials and traders recognize this as offsetting operating factors, since these sales are intended to offset the impact of the likes of fiscal policy, float, and so forth on reserves that would cause the Fed funds rate to move away from the Fed's target rate. Our main point is, in nations that include the United States, Japan, and others where interest is not paid on central bank reserves, the penalty for deficit spending and not issuing securities is not, apart from various self-imposed constraints, bounced government checks, but a 0% interbank rate as in Japan today. The overnight lending rate is the most important benchmark interest rate for many other important rates, including banks' prime rates, mortgage rates, and consumer loan rates, and therefore the Fed funds rate serves as the base rate of interest in the economy. In a state money system with flexible exchange rates running a budget deficit, in other words, under the normal conditions or operations of the specified institutional context, without government intervention either to pay interest on reserves or to offer securities to drain excess reserves to actively support a non-zero positive interest rate, the natural or normal rate of interest of such a system is zero. This analysis is supported by both recent research and experience. Japan's experience in the 1990s shows clearly that large government budget deficits as a proportion of GDP in the neighborhood of 7% and a debt-to-GDP ratio of 140% do not drive up interest rates, as conventional wisdom would have it. In fact, the overnight rate has stayed at near zero for nearly a decade. In addition, Scott Fullwiler, 2004, has demonstrated that concerns about technological change in financial markets and other recent developments, such as financial deregulation disrupting the interest rate channel of monetary policy, are misplaced. On the contrary, since the 1990s, market rates have become even more closely linked to the Fed funds rate. The fact that banks are obligated to use reserve balances to settle their customers' tax liabilities ensures that a non-trivial demand for reserve balances will exist, which itself ensures that the federal funds rate target will remain coupled to other interest rates. Fulwiler, 2004. That the natural rate of interest is zero is also supported by recent experimental evidence. L. Randall Wray, 2001, has reported on a community service program run in the economics department at the University of Missouri, Kansas City. Students are taxed in the department's own currency and must perform community service to obtain units of that currency. The department's treasury could offer interest-bearing bonds purchased by students with excess non-interest-bearing units of the school's currency, but the rate of interest offered is entirely up to the discretion of the departmental treasury. If the treasury did not offer interest-earning bonds, the base rate on the currency would be zero. The natural base interest rate is zero on hoards created through deficit spending, unless the Treasury chooses to intervene to maintain a positive base rate, for example, by offering interest on bonds. Deficits necessarily imply a zero base rate. Ray, 2001. Note that deficits with the department's currency are natural in the sense that they result from the student demand to net save units of that currency. The central bank clearly controls short-term interest rates in a state currency with flexible exchange rates, and there are a number of good reasons for setting the overnight rate at its natural or normal rate of zero and allowing markets to factor in risk to determine subsequent credit spreads. See Mosler, 2004. The Japanese experience has already demonstrated that this does not cause inflation or currency depreciation. If anything, lower rates support investment, productivity, and growth, while changing rates can have important distributional or micro effects, and that can spur employment and output growth, such as shifting income from savers to working people. The net income or macro effect is zero, since for every dollar borrowed from the banking system, there is a dollar saved, as the Fed clearly recognizes in its literature. Additionally, it can be argued that asset pricing under a zero interest rate policy is the base case, and that any move away from a zero rate policy constitutes a politically implemented shift from this base case.